basically my contention is the biggest fallacy and arguably the biggest lie that's told today is that stocks go up over the long run. And this is a great example of what's called post hoc ergo propter hoc fallacy. So it just means that post hoc is an important word or set of words in Latin, and it just means after the fact, post hoc. And so here, post hoc is sort of a logical, proposition. So ergo is which means therefore in English. Post hoc ergo propter hoc, which loosely translates into it happened before, so it'll happen again. And I think that's it's sort of one of the major fallacies you see in everyday life, right? Like horoscopes or superstitions or whatever. You know, if it rained on Tuesday every Tuesday for a month, you might think that there's something special about Tuesdays, and then you get really disappointed when for the next, year it didn't rain on Tuesday. And it's just this kind of human fallacy that we kind of, tend to sort of fall in love with repetition, and we fall in love with regularity, and the reality is that these things don't happen. So in this case, the post hoc is the performance in stocks over the last, say, 50 years or whatever. And so, it certainly happened before, and we'll go through that data, and exactly what happened is the question. And the supposition or proposition is that it'll happen again, whatever this happened. And we know in math that these things are generally not going to be connected. If you flip a coin, I don't know, this is heads and this is tails, we know that the outcome of flip one has no bearing on flip two. And in general, that we can I think of economic systems this way. Now, there could be systematic factors that result in this relationship being less than random, and we can talk about that. Why do U.S. equities seem to outperform other countries? Well, is that a systematic reason? Is this just sort of happen to happen? Is there causality? That's sort of the key question, and a lot of this boils down to basic statistics. And I think you'd be surprised at how many people didn't do any basic statistics in life. So I actually went back and I made this fancy spreadsheet, which you can actually get on the shared folder. If you don't want to do that, it's fine. You can just watch. There's no real sense in downloading it, but if you wanted to, I can. I gave you that opportunity. And yeah, if you talk about anything other than the contents of this course during my chat, you will get banned, and I don't have much apologies for that. So anyway, so here I put the S&P 500 index price for the last about 51 years. I didn't go back further. I could have, but I'm just here to prove one point. And here we have the 1 year rate of return, which is just literally the year this year over last year. Then I did 5 years, which is this is the geometric rate of return. And then I did 10 years, and then I did 20 years. So without any adjustments, and I'll show you what adjustments I made on the side here, but without any adjustments, you can see that recently the rate of return has been somewhat subpar. It's been on average about 3% over the last, say, 12 years. And if you just take the last literal 10 years, it's about 2%, which is not a fantastic rate of return. You don't invest part ways with your money for 2% returns. I think that's needless to say. And if you look at inflation side by side over the last 10 years, it's been 1.59%, while return on the S&P 500 has been about 2.4%. So net of inflation, you're talking about 80 basis points, which is a really interesting kind of figure. So what's even more interesting, though, is if you take the mean return, whether it's a 1 year return, a 7 year return, 5 year return, 10 year return, or 20 year return, you get about an 8% average return, which is really good. I've said before, the greatest investors in the world can return 10, maybe 15% a year. So if you can get 8% a year, that's a really phenomenal return. The problem is I think that that's a fallacy. And I think that we're told this for various reasons. The primary one is just lack of understanding and some sort of inborn optimism. The source of this data is just Bloomberg, but you can look up S&P 500 prices anywhere on the internet. The PCE is sourced from Bloomberg as well. I do make I have some sources for the Nikkei and RTS, but in general, if you don't see anything sourced, it's coming from Bloomberg. So, and we'll talk about dividends as well. But so if you take the max, the min, and the standard deviation, you get a little bit more information. Over the 20 years, you get this really nice 8% with a standard deviation of just 3%. So it's a really lovely result, right? If a 2 sigma return, negative 2 sigma return is still positive, that's a nice place to be. But again, I'm going to explain why there's a fallacy going on here. So I did this column and I adjusted for inflation. And when you adjust for inflation, the rates of return get approximately halved. So inflation eats up about half of that return. And what is inflation exactly? We're going to actually talk about that a little bit. But you can see that the supposed 8% return is actually more like a 4% return. And then I take into account taxes, which is something that almost nobody takes into account. So we can argue that the US is like this structurally gifted, systematically gifted country where our equities will always outperform, which I think is a ludicrous kind of proposition in the first place. But if you assume that and you take the capital gains tax rate, so I'm taking the real tax rate, which is what I pay, long-term capital gains, so this isn't short-term capital gains, there's two different rates, and it's a 20% national or federal tax rate, and then it's something like an 8 to 10% state taxes. So if you're the average investor in the United States, you're talking about a 29% capital gains tax. So almost a third of your profits have to go back to the government. And I'm actually not adjusting this in ways that I should to penalize it further. I'm being pretty nice because remember, you're paying a third of your gains, but you're not getting anything back for your losses, which are a real possibility. So if you take that out, you're talking about, at least over the last 10 years, a negative real rate of return. And even over 20 years, only a 4% rate of return. And I think that would drop to sort of 2 or 3% if you looked at some other sort of more fair numbers. So you're really sort of in a position where I don't think you should assume that stocks go up over the long run, because first of all, it's sort of a pretty ridiculous hypothesis to begin with. Why should anything go up over the long run? Why should there be any free source of gains for you? I mean, it's a very naive perspective if you think about it. I mean, you have to be a little bit foolish to think that there's a big pot of money available for you that is not available or is widely and infinitely available for everybody. It just doesn't make any sense if you think about it. Furthermore, there's a lot of sort of other things here that we're not talking about that are a drag on this real rate of return, but I think I've sufficiently proven that you're getting somewhere between a negative rate of return and a small, very small positive rate of return if you're talking about the S&P 500. But again, we're really still dealing with a fundamental problem here, which is this is the best that we've got. The very best that we've got is a 4% return, but we still haven't dealt with the issue of selection bias. We're looking at U.S. public companies. Why are we looking at U.S. public companies? Why are we looking at Indian public companies or Chinese public companies or Russian or Japanese public companies? And I'm going to do that in a second. But the whole point of selection bias is that we're looking at the very best and we're extrapolating backwards, which is a terrible, terrible mistake logically and statistically. For instance, if we said that, if we looked at Michael Jordan's, track record as a basketball player, and we assume that you can have that same track record as a basketball player, you really are, you would never do that. You would understand that that's foolish. Well, if you do that for the Nikkei or for the Russian stock exchange, you really get into a huge problem. So let's look at that for the Nikkei. And I didn't adjust these for inflation. And what's interesting about the Nikkei is you have these really long periods, for instance, the post-war periods. This goes back to 1949. So this is the rebuilding. This is the end of World War II. This is the rebuilding of Japan. And you can see it rebuilt pretty damn well. The index was 100, benchmarked at 100 in 1949 when it was created, and if you invested in 2016, you're looking at a 17,000. So how many years is that? It's about, let's see, it's about 68 years. So we use the Excel equals rate, 68, 0, present value is negative 109, future value is 17,000. It's an 8% return over 68 years. And you would think, wow, that's pretty amazing. But again, we have a lot of selection bias here. Is our hypothesis that we want to buy countries after they've been through World War II, or Great World Wars? I mean, that is sort of the hypothesis here. This isn't a reasonable continuing hypothesis. And you can see that in the last 22 years, the average rate of return for Japanese stocks has been negative over a 10-year period. And why is Japan any different from the U.S.? Well, it isn't. You know, we picked the U.S. because of selection bias, but if you pick any other country like Japan or Russia, you'd find that these are really problematic things to deal with. I haven't even adjusted for inflation or taxes here, and you're really dealing with gigantic issues. Here you have a 20-year negative expected rate of return for Japanese stocks. I mean, that's not including inflation. There is not much inflation in Japan, if any. It's sort of negative, but you still have to reconcile the fact that if you're an investor, you have opportunity cost. You should expect positive returns. So you're taking the risk of equities, mind you, which is riskier than debt. You're supposed to get paid more, and you're not making any money. So I think that this is all really interesting, but the big myth that you can just make money by putting some money into a box and expecting it to go up is really, really ridiculous. I had a chat with, or I looked at a chat that Chad Ochocinco, the football player, had. And he actually reminded me of my family, who never invested in anything. And actually did just fine doing that. By focusing on your savings and your earnings, you can actually do much better often than by being distracted trying to become an investor. So I think that if you watch the cynicism and skepticism of a football player, carefully denying all the investment opportunities in the world, and my parents who were immigrants with no education, I think that's actually more wise than trying to believe this lie that stocks go up over the long run. And I probably owe my parents an apology from a very long time ago when I insisted that they invest. So anyway, what I wanted to do is talk a little bit more about some of these dynamics and kind of discuss macroeconomics in general and how hedge funds and things like that operate them and operate funds in this area. And one of the things, so I in the Investing Basics PowerPoint, which is now a whopping 62 pages, I added some things in red.